Good morning from our global headquarters in New York. I'm Menace Cranny alongside Danny Berger. You're welcome to Bloomberg Brief. I set that agenda.
Countdown to CPI, event risk abound for markets, treading water ahead of inflation and bond auctions. A message from Chair Powell, we're not in a hurry to cut rates. He returns for day 2 of his congressional hearing. And a Washington revamp, President Trump directs federal agencies, ready yourself for the DOGE job cuts.
Yep, that was a heck of a press conference. More on that throughout the show. Stocks steady as she goes at the moment, 21,763. Powell's not in a hurry. We'll talk more about that. Great message from the Ford CEO. There's a lot of cost and a lot of chaos. Consumer discretionary took the heat of this market on the downside yesterday. Roll it over, have a look at the bonds. We're down to one rate cut. I like what Evercore had to say about Powell's testimony. It's confirmation. Policy rate is in a good place, according to Powell. Evercore, we are in an extended timeout on rates, Danny, as 2-year inflation swaps hit the highest level in 2 years, going into day 2 of testimony.
Higher energy prices certainly not helping with that yesterday. While markets tread water, we do have some individual stocks on the move, Alibaba being one of them, surging after the information reported that Apple is working with them to roll out AI features in China. Those shares up nearly 4%.
Super Microcomputer jumps after the chipmaker issued an aggressive long-term revenue outlook and pledged to meet the NASDAQ deadline to file those audited financial results. Stock up 5.5%.
Then to the other side of things, Lyft shares are falling the pre-market trade more than 12.5%. It gave a forecast of first quarter gross booking warnings that cold weather has hurt demand for ride hails and for bike rentals.
In just a few moments, Henry Allen of Deutsche Bank, and later in the hour, Jose Torres of Interactive Brokers ahead of the CPI. And this is what I think this bond market is sort of hanging its hat on. It got a clear message from Powell yesterday, Danny. They're not in a hurry. He's got the cover. He needs all the cover that they need as much cover to sort of stay on hold until we know the color of the tariffs.
And to be clear, it's not just this bond market. It is this equity market, too. It's amazing. We've talked about this day after day, the resilience of this equity market when it comes to DeepSeek, when it comes to tariffs. The thing it has been sensitive to is inflation. Just look at our reaction to the UMich survey on Friday. That served to move equity markets. And January is a really important month for CPI because it tends to be that time of year that firms reset their prices higher.
And a lot of scathing comment about those UMich numbers. We broke them on Friday morning, 100 basis points higher than the market had anticipated. A lot of people talking about the politicization of UMich, but it is what the Fed looks at. And look at China, lit up like a Christmas tree. Tech back in a bull market in China.
Well, part of the UMich problem was that Republicans were starting to become more fearful of inflation. But just on this note of the trades that are working and ones that are not, man, it's one interesting feature of the market so far in 2025 is the things we thought would be the Trump trade have been misfiring. You look at the euro, stronger versus the dollar. Renminbi, stronger versus the dollar. European stocks have hit an all-time high, as have the DAX, as has the FTSE. Mexican stocks outperforming the S&P 500. A head-scratcher and not quite what people would thought would happen when Trump took office. I'm pleased to say joining us now is Henry Allen, macro strategist at Deutsche Bank. Henry, can I just get your thoughts on that point? Why aren't these so-called Trump trades working so far in 2025?
Well, I think as is often the case in markets, when you've got a situation where everyone's got a playbook, often that playbook starts to break down. So a lot of those Trump trades were already priced in straight after the election, and everyone's assuming it's going to be like 2016 again, when it's just not. And actually, one thing that I think is a key difference between now and 2016 is going into the 2016 election, the S&P 500 and broader risk assets had been basically flat in the year and a half before the election. Actually, in early 2016, we had that kind of recession scare as a lot of manufacturing indicators turned down. By contrast, in 2022, we had a big fall, and then 23 and 24, we had a relentless surge in equities. So there isn't the same scope for that catch-up potential there was in 2016.
Henry, good morning to you. You describe yourself as being fairly bullish. I just want to know whether you're an embracing bull or a reluctant bull for risk.
I'm an embracing bull, actually, because I just don't see, and we've already seen this year with DeepSeek, with tariffs, the equity market has proved remarkably resilient to a lot of those risks. And actually, I think a lot of the risks, like tariffs, are already priced in. You look at the broader macro backdrop, the ISM manufacturing at its strongest since late 2022, when the Fed were aggressively hiking rates. Payrolls on Friday, the 3-month and the 6-month average moving higher. And I don't think the Fed are going to hike rates anytime soon either, having just cut by 100 bips. I think to hike in the near term would be basically to admit they made an institutional error. So I think there's a fairly high bar in the next 6 months of the Fed turning around and hiking. So I just don't see any of those big risks on the near-term horizon materializing. So fundamentally, I remain pretty bullish.
Powell yesterday saying we don't need to be in a hurry to adjust our policy stance. Henry, is there not some risk in that, just given the current political backdrop, that you had a Fed that was calling nonstop for cuts, that they needed to have a shift, a paradigm shift to bring easing to this economy? And then post-inauguration, you have a Fed that's reluctant to move at all. Whether or not that's political is a different question, but it's the appearance of seeming political.
Well, I think the Fed have proven themselves pretty insulated from that so far. I remember last year there were a lot of concerns, the fact they began their hiking cycle in September, right before the election. Yet they did that with a larger than usual 50-bip cut, and there wasn't a great deal of reaction to that on the political side. I think it was recognized that given the labor market data at the time, that seemed like, at the time, a sensible thing to do. And since then, the data on both the labor market and the inflation front has shifted in a more hawkish direction. So I think it's completely understandable that the Fed themselves would also shift in a more hawkish direction. You saw that in the dot plot in December that was notably more hawkish than expected, only penciling in 2 cuts for this year rather than 3. And given, Powell's term goes up until early 26, I think, for this year at least, I think they're relatively insulated from those kind of political pressures.
Henry, let's just build on that. If you look at the structure of this market going into the CPI, 2-year inflation swaps are at the highest in 2 years. Break-evens also trading higher. How do you embrace that rather than fear that from a positioning point of view?
So I wouldn't say it's something to embrace necessarily, because clearly I think inflation risk is one of the biggest near-term risks for the market right now. And if PCE does start to move into the 3s, and it's currently in the 2s, I think that would change the dynamic from the Fed's point of view. But where that could actually be bullish potentially is you could get a situation a bit like we saw both in late 23 and late 24, where because inflation risk is already priced in quite strongly, if that actually starts surprising on the downside, then that potentially opens some upside risks there for risk assets.
Henry, we've also seen gold over the past couple weeks surge higher. It's easier today, under $2,900. But even so, it's had a 10% run so far this year. Is gold telling us something the rest of this market isn't, considering the buoyancy of risk assets elsewhere?
I think it again speaks to that fear of inflation, basically, that, even in the last 24 hours, we've seen the EU say that they will retaliate with their own tariffs if Trump imposes them on them. We've seen oil prices rise for a 3rd day running. So I think gold, which is a classic inflation hedge after all, is speaking to that risk. And I think there's also, alluding to what I said earlier about, I think the Fed are unlikely to hike in the near term, gold is also negatively correlated with real interest rates. And if the Fed are reluctant to hike in the near term, even as inflation creeps higher, a bit like we saw back in 2021, then I think that does pose some upside risk for gold, because inflation is coming in stronger, but the Fed might not have as aggressive a reaction function as they did a few years back.
Well, there's certainly a lot of central bank action on the gold front. Henry, we deal with daily volatility, with daily tariff headlines, which makes taking unique positions a lot harder, or naked positions a lot harder. One theme that has come through from a number of people that I've spoken to is prepare some kind of carry trades, look for carry trades. Now, in the FX space, that's hard, but what would that mean to you if you're searching for carry trades to take you through the volatility?
Well, I certainly think there's opportunities to pick up quite a lot of coupon actually at the moment, particularly given how high interest rates are relative to recent history. You can get 2% plus CPI simply by sitting in a US 10-year real yield, a very safe asset right now. But I also think, obviously, the market is quite scarred by kind of this carry trade phenomenon, given what happened last July into August with the yen carry trade, which completely blew up after a lot of places hold highly leveraged positions in that. So I think there's still some wariness over those traditional positioning, but certainly, the fact that interest rates, and real interest rates indeed, have risen significantly in the last couple of years means we're in quite a different environment, and you can earn, a decent coupon just by sitting on pretty safe assets.
Tip the coupons. Henry, thank you very much. Henry Allen there of Deutsche Bank, framing the risk for us on the show. Other stories trending on your Bloomberg terminal, this is what we got for you. The UK economy has shrunk in the 4th quarter, putting it back on the brink of recession. The Bank of England estimates 40% chance that Britain is already in a technical recession, with growth flatlining and the cost of living pressures deepening. Chancellor Rachel Reeves may have to cut spending on public services and welfare unless the outlook improves.
Han Hai says it's open to buying Renault's stake in Nissan. That could offer the Japanese car maker a lifeline. It has approached Nissan and Honda about potential cooperation after the two are thinking of ending their alliance talks. A representative for Honda declined to comment. A Nissan spokesman said that the company was aware of the reports, but declined to comment further.
Shares of Heineken surging after the brewer announced a buyback and reported strong beer sales. The rise in volume was driven by strong demand for premium brands and non-alcoholic products, beating the analysts' expectations. Global brewers are trying to grow their share of markets where consumer sentiment is still recovering.
Coming up on your brief, federal job cuts. President Trump directs agencies to work with DOGE and cut jobs and slash spending. We're going to have the details for you next.
Transparency is what builds trust, not simply somebody asserting trust. So not somebody saying they're trustworthy, but transparency, so you can see everything that's going on. And then you can see, am I doing something that benefits one of my companies or not? It's totally obvious.
And we thought that we would not let him do that segment or look in that area if we thought there was a lack of transparency or a conflict of interest.
President Trump standing firmly behind DOGE. That's as Bloomberg sources reveal the president is directing agencies to work with Elon Musk's government efficiency department, cut their costs and slash their workforces. Kevin Whitelaw is with us. I mean, this was a very, very substantial press conference yesterday. This was about defense of DOGE. This was about transparency. And this was about the preparedness to go to Congress to give DOGE teeth, wasn't it?
Well, ultimately, I think we're still in this strange place where Musk's operation is really sort of still just in an advisory capacity. Really, these aren't government employees. They don't have security clearances in the normal chain, and so they don't really have sort of the authority as such. And so the courts have stepped in and obviously tried to freeze or slow down elements of what he's doing. But Trump is clearly very serious about his plan to shrink government. He's really looking at different ways he can reduce the size of the federal workforce. But in the first term, he kept running into legal obstacle after legal obstacle. And one of the challenges this time he's facing is that government spending, is Congress's job. It's Congress's role to appropriate, to allocate money, and then the federal government has the implementation side of that. And so ultimately, he's going to have to figure out if he can persuade Congress to go along with it, or if he can just barrel ahead and essentially find ways around the courts or through the courts to accomplish what he wants to do. So this was about giving Musk legitimacy from sort of the political side, but they still have to sort of figure out how to do it from the legal side.
Fair enough, Kevin, because this was the discussion in the creation of DOGE, that it's not a government agency, it's just an advisory. So what power do they have? We keep asking this question over and over again, as we did in the first Trump term. What power do they have to do certain things? The latest coming from the Wall Street Journal on that front, with the Trump administration advisors examining whether they can collapse the FDIC into the Treasury. Kevin, what do we know from their reporting as to whether it's possible and what the impact of that might be?
Well, I mean, I think as much as anything, it shows you that there's sort of nothing off limits, at least in what they're kind of considering. I mean, the FDIC is sort of, the blue chip institution that is, obviously sort of undergirded the U.S. banking sector for a very long time, and has given sort of the financial sector a real sense of comfort. So I do think that it shows you that they're going to look at every different possible thing. But, a lot of these are grounded in statutes, so a lot of them will indeed require legal changes or congressional changes. But, we've seen Trump's willingness to move forward and sort of then essentially challenge people to stop him and see if there's ways to slow him down. I think in this case, the fact that this got out there will also mean that there's a chance for the market and the financial sector more broadly to react. And we do know that Trump is sensitive at times to where Wall Street and sort of financial managers are on issues like this one.
Well, Kevin, we saw some very poignant images. Mark Fogel returning from Russia. He'd been detained for 3 years with the president. There you go. There are the pictures. This was last night. The president calls this is a very goodwill in terms of the war. He's ready to send Besant to meet Zelensky. So this is sort of all movement forward towards some kind of a framework for peace.
I mean, it's certainly movement. I mean, toward what? I think we're still going to have to see. I mean, the Trump administration is working on, under Keith Kellogg to try to come up with some form of a plan, apparently, but obviously we still have yet to see any details. We have heard Trump talk about wanting to make sure that the U.S. has access to Ukraine's critical minerals as part of any arrangement to continue supporting the country. But again, we don't know exactly what that means. Ultimately, the decision maker here may not be Trump, but Russian President Vladimir Putin. And you know, it's really, Putin has made his aims extremely clear. There are aims up to now that have not been remotely acceptable to almost every member of NATO, and obviously not totally unacceptable to the U.S. up until at least the Trump administration. So we're going to have to see whether Putin has any interest in negotiating. He has been, in some ways, very, 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 very slowly gaining ground, and he may think that the war of attrition actually sort of works in his favor.
Kevin, really appreciate the update. That is Bloomberg's Kevin Whitelaw. Coming up on the show, a drag ahead of a push. SoftBank posts a quarterly loss, but still with that AI bet with OpenAI simmering in the background, we're going to have the details on their earnings coming up on your brief. It's your Bloomberg Brief. Danny Berger and Manus Cranny in New York. Time for your front page news. A look at what's making headlines around the world. First up, the Wall Street Journal leading with the U.S. school teacher Mark Fogel being released from Russia. He was arrested back in 2021 on drug charges. The White House said that President Trump secured the release as part of an exchange. They didn't offer any further details on that front. Trump greeted Fogel at the White House Tuesday night after he landed back in the U.S. Next up on Bloomberg, Spirit Airlines rejecting yet another takeover from the rival Frontier. It will instead press on with its own recapitalization plans. Under the terms, I should say, of the new proposal, Spirit stakeholders could have received $400 million in second lien debt issued by Frontier and 19% of Frontier stock. Finally, the Financial Times reporting on the boom in tech in Asia, specifically zooming in on SoftBank, though, and had a $2.4 billion loss, making big bets on AI. It was also weighed down by a drop in the value of the Vision Fund's public holding. Masayoshi-san, as you'll recall, is on a campaign to raise $500 billion for the Stargate AI project. On this story specifically, let's bring in Bloomberg executive editor for global technology, Peter Elstrom. Peter, it is an encapsulation of so much what's happening with tech. All these AI bets being possibly upended by DeepSeek, but at the same time trying to invest in the U.S. How are all these things going to come together for SoftBank when they are seeing poor earnings?
Yeah, well, SoftBank certainly wants to be one of the major players here. What we saw in the quarterly earnings was, as you mentioned, a loss of $2.4 billion. It's important to remember that SoftBank itself has changed a lot over the past 10 years. It used to be a telecom operator primarily that would make some investments, and you could kind of see how its revenue and its profits grew. Now what happens is SoftBank marks up and down its portfolio, especially of publicly held companies, and reports losses or gains because of that. So in the last quarter, we saw a couple of their major holdings, Coupang, the Korean e-commerce company, and then Didi, the ride-hailing company in China, fall a bit in the market, so they marked down, they took this loss. Perhaps more important, though, is that the cash on the balance sheet at SoftBank actually increased. They've also had some other gains in other parts of their holdings, including ARM has been a very strong performer for them. So Masayoshi Son has been quite confident that he's going to be able to raise this money to make investments in OpenAI in particular, and then more broadly, the Stargate venture, where he's trying to raise, as you say, as much as $500 billion. We did report recently that that could be a small amount of equity and then a lot of debt. Money is still quite cheap in Japan, of course. They're looking at putting in as little as 10% equity and then using debt and other kinds of instruments to make up the difference if they do end up raising that $500 billion.
Peter, we're just looking at the Hang Seng Tech. It's on the front page of the FT. It's on top red, etc. This is China Tech getting its deep seek moment. It really is infused a rally. The question is it reminiscent of 3G, 4G, 5G? You know, how much legs does this rally have in the Hang Seng Tech?
Yeah, perhaps more broadly, this is an AI moment for China. DeepSeek, of course, is privately held, not publicly traded, but it sort of showed the world that some of the Chinese companies can make these kinds of breakthroughs. We saw Alibaba in particular benefit, in part because they've been pushing quite forcefully into AI. They have a nice AI model, Gwen, that's gotten a lot of attention. They've claimed that on some metrics it's even better than DeepSeek. They're also looking at some partnerships, perhaps with Apple and some other companies there.
Let's see how much further it can run. Peter, time has run against us at the moment. Peter Elstrom there on the big tech moves in the Hang Seng.
From our global headquarters in New York, welcome to Bloomberg Brief. Danny Berger and Manish Krani here at Let's Set Your Agenda.
Countdown to CPI, event risk abound for markets, treading water ahead of the inflation and bond auctions. And a message from Chair Powell, we're not in a hurry to cut rates. He returns for day 2 of his congressional hearing. And a Washington revamp, President Trump directs federal agencies. Ready yourself for DOGE job cuts. Danny, good morning.
Good morning, Manis. Well, none of those things shaking up markets. Will CPI today be the thing that does? 0.3% month over month is what's expected. We're lower by 0.1%. The S&P 500 still within 1% of another all-time highs, but not much movement for the NASDAQ and Russell. Not much movement for this bond market, too. We are higher on the front end by just 1 basis point, 4.29%. For your 10-year yield, that also treads water. We're back above 4.5 after Powell saying we can move slow, but really, who was surprised by that? Finally, just want to give you a snapshot of the euro. Some lines coming from ECB Governing Council member Robert Holtzman, talking to CNBC, saying that cutting by 50 basis points would be a bad decision. But here's the key, Manis. He says that we have a threat of higher inflation rates, and we need to be careful, citing things like tariffs. It's not just an American problem, it's a European one, too, and it means that the dollar strength hasn't necessarily been playing out.
No, and we just had a conversation there with Henry Allen. He talked about that institutional error that the Fed made when they cut not just by 50 in September, but 100 over that period of time. And the risk is this. Universal tariffs are still out there. Reciprocal tariffs, the breadth and the magnitude, that is what the bond market, Beam will make this point, that is what the bond market has got to grapple with. The breadth and the magnitude of reciprocal tariffs and what are universal tariffs. Who's going to suffer from them?
You could say the bond market's grappling with it, but yields are still lower on the year. Yields are still lower. International stocks are still outperforming. The Euro Stoxx 600 is at a new record. The DAX is at a new record. The FTSE 100 is at a new record. It's trades that we didn't think would happen this year. It is an anathema to the Trump trade.
I think, as you said, and we discussed this with Henry, which was all of those classic Trump trades that we thought that were going to come true. I mean, the bond market has come back by 40, 50 basis points, and it's just slowly, incrementally going higher because you've got inflation. Inflation is sticky. It's just inching higher. Inflation swaps are at a 2-year high. So there is the push and the pull with the bond market, as you say.
Well, thank you for setting me up perfectly to talk about CPI, Manis. It's almost as if we had it planned. CPI print that's going to come in less than 3 hours' time. To really do the setup for us, it is Bloomberg's Mike McKee, who is down in Washington, D.C., to take us through the numbers. Mike, what are we expecting today?
Well, the forecast consensus is that we might have a good month, only a 0.3% gain, down from 0.4 in November or in December. These are January numbers that are coming out today. No change in the core, and it brings us down by a tick for the year-over-year number on the core, and no change on the headline. So it isn't dramatic. However, there is one thing that you have to keep in mind going into this, and that is there's a seasonal pattern over the last couple of years where the late year and early year months surprise. Last year, we saw the Fed taken by surprise by an increase in the CPI, and it is possible that we could get, some analysts are predicting, that we could get an increase in the July number, maybe our January number, maybe 0.4 again, or even above before inflation starts to go back down again. You can see the pattern there on the screen. So So if that were the case, then you might have quite a negative market reaction.
Day two for Jay Powell on Capitol Hill. Evercore, I think, encapsulated yesterday perfectly. Extended timeout on rate cuts. When you listened to Powell yesterday, he's not in a hurry, but I thought it was interesting what he had to say about the labor market as well.
The labor market basically is in good shape as far as the Fed is concerned, and it is not inflationary. They're keeping an eye on things, and maybe we're going to see some layoffs start to tick up. But so far, what Fed officials are saying is businesses in their districts are telling them that, no, we're not hiring, but we're not firing either. As long as the consumer is spending, we're still seeing strength. We need to meet the demand. So it's kind of a Goldilocks situation for the Fed here, but of course nobody knows how long that's going to last.
Well, we've heard from other Fed officials too, Mike, save for Powell. We heard from John Williams yesterday saying that they're moving towards a 2% goal. But, quoting here, it's important to note that the economic outlook remains highly uncertain, particularly around potential fiscal, trade, immigration, and regulatory policies. That uncertainty, Mike, do we have any clarification how Fed officials are incorporating that into their outlooks?
No, they're watching Elon Musk with his son on his head in the Oval Office the same way we all are, and wondering what the president is actually going to do. We got a little bit of a clue with the 25% steel and aluminum tariffs, but we still don't know who might be accepted from that, or whether they might give some countries a slightly smaller tariff. Then there's the universal tariffs. There's this threat still hanging out there of tariffs on Canada and Mexico. So the Fed has just got to sit back and wait, and there's really nothing else for Jay Powell to say, which, to his credit, Donald Trump admitted after the last Fed meeting that the Fed pretty much had to do that.
OK, let's see what the data brings to us today, along with day two from Jay Powell. Mike in Washington. Joining us now around the desk is Jose Torres, senior economist at Interactive Brokers. Good morning to you, sir. Welcome to the show. Sticky inflation, it's talked about, it's manifest, it's in the break-evens, it's in the swaps. How sticky and enduring is this inflation?
Well, thanks for having me, Manis. Danny, good morning. It's quite sticky. You know, we haven't been at the Fed's target in roughly 4 years. You know, the Fed hasn't wanted to bring rates to a restrictive level to get inflation down there. We've had multiple aspects. We've had labor-intensive services, wages. We've had shelter be sticky. Goods, however, was that consistent force from 2022, and we saw those 8 and 9 handles on CPI down now to the high 2s and I think the low 3s as we progress into the year. But the bar is high for the Fed to hike again. So I think the Fed is going to stay here for quite some time, despite inflation remaining at around 3%. In terms of what can go right for inflation this year, I think shelter, which makes up almost half of the CPI basket, roughly 45%, and energy. I think energy costs can come down through the administration's moves on deregulation and drill, baby, drill. Maybe we see WTI in the 60s or maybe the high 50s, right? And then the shelter component, something no one's talking about, Danny Manis. No one's talking about the shelter component and how immigration restriction can incrementally drive up vacancy rates and soften those rents.
So if you have that force as something that could go right, what would be the push-pull between that and tariffs? What would win out as the greater inflationary force or disinflationary force?
Well, I think that the former points, the shelter would be, and the gasoline and the energy would be more predominant force. But on tariffs, you know, I really think that the outcome is going to be better than feared, right? We see that similar to debt ceiling negotiations, a lot of these discussions and these tactics that go down to the wire, like that weekend with Canada and Mexico, and then that got postponed for a month.
So with your narrative, it's about DOGE, deregulation, and energy. So are we underassuming the capacity of DOGE? If you listen to that press conference yesterday and the emboldened narrative from the president, is the market underassuming DOGE and what it can deliver?
I think it's pretty neutral. We got to remember the federal workforce is only roughly 1.5% to 2% of total employees, right at around 2 million. So it's not that significant in terms of the impacts on consumer spending and on the labor markets. And then also remember Treasury Secretary Bessent keeping those auction sizes steady, showing some discipline on the fiscal front. That's also helped cap yields and allow equities to maintain these elevated valuations. And perhaps this year we can let I think earnings are going to be buoyant. I think consumer spending is going to remain strong. Labor markets, this last report, January, got me a little nervous. The average hourly work week actually declined. You ready for this? To the lowest level since COVID at 34.1. And to go before that, you have to go all the way back to 2010. And then the breadth of the sector participation was also particularly weak. We had some job losses in leisure and hospitality, which is a big discretionary sector. And then from the sectors that added jobs, those jobs were the headcount additions were very limited. They weren't that buoyant. They were below 10,000.
Can I press you on the point about the labor market coming from the federal government? Because there had been job reports where the robustness was because of government hiring. And it goes beyond that, too. Maybe different contractors they work with, or even the military, if there are cuts there, America's biggest employer. Does that not have any impact whatsoever on a more macro level for this labor market?
I think it does, but overall, we have a lot of space to accommodate some of those layoffs in the private sector. We got the NFIB survey yesterday at 6 in the morning, and small and medium-sized business owners are reporting job openings and labor quality as one of their top issues, right? They cannot find capable workers. And in the federal government, there's a lot of skilled workers there. So there could be some replacement where a lot of those folks move into the private sector and really contribute to the nation's productivity.
Listening to Chairman Powell yesterday, he talked about the labour market being broadly imbalanced, not a source of significant inflationary pressures. Now, given what you've just said there, you would concur with that. So the risk is to the downside and perhaps a bit of slack in this labour market?
Yeah, absolutely. I mean, wage pressures are quite strong, but those payroll gains are going to slow down, right? What Danny just said on the federal government and all its associated entities, but then also on the immigration, right? Those immigrants that were coming in, a lot of them, as soon as they come in, they want to work. They're here for the most part for economic prosperity, which they find via the labor market. So we're going to have immigration restriction that's going to bring down payrolls and, the federal government as well. But I still think economic growth is going to accelerate. Capital expenditures, my forecast for this year is 3.3% on GDP. Capital expenditures are going to be quite buoyant. I think interest rates stay quite limited. We don't want to see the 10-year above 5%. Treasury Secretary was really, vocal about focusing on the 10-year. Also takes pressure away from the Fed. We don't want a Trump 1.0 quarrel between the White House and the Federal Reserve. That stuff is ugly. We don't want to see that. Trump appointed Powell, right? So it's nice to maintain that precedent of Fed independence.
Yeah, and to be fair, Trump recently has been saying, as Mike pointed out, they did the right thing by holding. So you've seen a little bit more of, or at least less of, criticism there. You mentioned the NFIB business survey. We also spoke to Lori Calvasino earlier in the week, and her team at RBC was looking through all the various earnings statements from these companies. Words that kept coming up: fluid to describe the current conditions, cautious, uncertainty, sluggish, softer, challenging, and evolving. When there is uncertainty, whether or not tariffs have more than a one-time impact, at what point does uncertainty itself become a problem? And you see slowing CapEx, you see slowing business decisions to impact the overall economy.
That it's hard to say, but it is a weight, definitely on corporate and business outlays. But I don't know that the uncertainty is necessarily going to slow down that activity. I think that. Look at the ISM manufacturing survey. The manufacturing sector is feeling really optimistic about, this domestic push to measures to incentivize manufacturing stateside. Do
you not worry about the consumer confidence being at a 7-month low?
Consumer confidence has been low for so long. Inflation has been weighing on consumer sentiment. Also, higher interest rates, reduced credit availability. At the lower end, Manis, they have jobs. They're spending almost all their money. The savings rate is down. They feel confident about their employment opportunities. And then at the upper end, the buoyant capital markets are really, really powering the consumer through.
Yeah, bad sentiment, but saying something different with their wallets, I guess. Jose, thank you so much for joining us. Always really lovely to have you here in New York with us. That's Jose Torres of Interactive Brokers. Coming up on the program, the Trump-Musk looking to revamp Washington with layoffs and spending cuts. We're going to have all of that for you next on your Bloomberg Brief.
Transparency is what builds trust, not simply somebody asserting trust. So not somebody saying they're trustworthy, but transparency, so you can see everything that's going on. And then you can see, am I doing something that benefits one of my companies or not? It's totally obvious.
And we thought that we would not let him do that segment or look in that area if we thought there was a lack of transparency or a conflict of interest.
Trust and transparency. That's what President Trump and Elon Musk say this administration uses in its approach to shaking up the government. Bloomberg sources tell us that the president is directing agencies to work with Musk's government efficiency department, which, by the way, is an agency, not a department, to cut their costs and slash their workforces. Joining us now is Meghan Crane in Washington. And Meghan, I say that because that had been much of the narrative when we learned about DOGE, that they were an advisory force, that they wouldn't have that much power ultimately. Does Trump's directive change that?
Good morning. Like everything about DOGE, it's somewhat unclear how much power they have. But he's advising the president, who is certainly making his assertions about the size of the federal workforce. A lot of his moves have been tied up in court, and these may as well. But also, federal workers have a lot of protections for when they lose their jobs or get laid off. So in some instances, it might actually work out better for them than any cuts that Elon had proposed previously.
Meghan, good morning to you. We're beginning to understand the narrative around deregulation, and this is an interesting one because this is about the prospect of rolling the FDIC that backstops our bank deposits, rolling that into the Treasury. This is in the Journal, front of the Journal. What do we know about that? Is that this first step in a major overhaul of a lot of these regulators?
That's definitely the concern of the Democrats in Washington. Like yesterday, Elizabeth Warren sent a letter with other Democrats asking for more information about these plans and really raising red flags about deregulation in the banking industry, especially in light of a stop work order at the CFPB. So anyway, I think that it's unclear, like everything. I feel like I say this every time. It's getting tied up in court. Will there be sweeping change? That's certainly the intention of the Trump administration.
Well, one of the things that may make or break some of Trump's aims is the cohesion of the Republican Party. Meghan, this has been another thing widely discussed. And they're now still trying to figure out how they meet different funding deadlines, how they get tax cuts done. What is the state of Republican cohesion?
So far, the Republicans have managed to sort of toe the line, but unfortunately, unfortunately, their margin is so slim that, and they have very diverse parts of the party who really want different things. There are people who just totally want cost cutting, and some who want to advance the Trump agenda more broadly. And whether they're able to do that in the next few days is really unclear. And also, the threats of a government shutdown is kind of the only power the Democrats have at this moment. It's not something that they generally would latch onto, but whether they are able to sort of come to agreement is really, really on Mike Johnson and whether he can make it happen. And it seems like it's pretty dicey at this point.
Now, another major sort of story is in the overnight. We saw the images of the American teacher, Mr. Mark Fogel, returning and standing in the Oval Office with the president. Again, the president describes this as, I think there's goodwill in terms of the war. It's a very important element. We're seeing Vance meeting Zelensky. We expect Besant to go to Ukraine. There's a real velocity behind the framework for some kind of a beginning of a peace plan, isn't there?
Yeah, I think Zelensky has certainly been mentioning in the willingness to negotiate on a lot of issues, like territorial issues. And he's certainly but he's also asking the United States for defense, right? And offering up minerals as the president has requested in order to get more American defense. Overnight, there was bombing in Kyiv while Besant's on his way there, which I think is particularly interesting. It's a very sticky situation. It's very tricky one for Trump, but he has made his intentions on that very clear. I thought it was really interesting that the first Trump administration official to go to Kyiv is Besant, right? Which sort of flags the importance of financial cooperation for the Trump administration.
Indeed. Well, it's going to make this Munich Security Conference pretty focal for a lot of those allies. Meghan, thank you very much. Meghan Crane in Washington. Other stories trending on your Bloomberg terminal this morning. This is what we got. The UK economy may have shrunk in the fourth quarter, putting it back on the brink of recession. The Bank of England estimates a 40% chance that Britain is already technically in a recession, with growth flatlining. The cost of living pressures are deepening. Chancellor Rachel Reeves may have to cut spending on public services or welfare unless the outlook improves.
Han Hai says it's open to buying Renault's stake in Nissan. That could offer the Japanese car maker a lifeline. It has approached Nissan and Honda about potential cooperation after the two started to think about ending their alliance. A representative for Honda declined to comment. A Nissan spokesman said that the company was aware of the reports, but declined to comment further.
And shares of Heineken surging after the brewer announced a buyback and reported strong beer sales. The rise in volume was driven by strong demand for premium brands and non-alcoholic products, beating the analysts' expectations. Global brewers trying to grow their share in markets where consumer sentiment is still recovering. Coming up in the show, it's a busy day for data. It's day 2 of Powell. And, of course, the CPI. We'll count you down to your data slate in just a moment.
This is Bloomberg Brief. Danny Berger and Manus Cranny in New York. Let's set up your trading day on this Wednesday. The main event, 8:30 a.m. Eastern Time. CPI numbers will come out. 0.3 is what's expected month over month. Then Fed Chair Powell will testify before the House Financial Services Committee. We'll maybe get a first reaction to CPI. That happens or kicks off at 10 a.m. The Treasury will also sell $42 billion of 10-year notes, Manus. That will occur at 1 p.m. Eastern.
All eyes down on that. 3 years went fine yesterday. It's all about tech, Danny, this morning. Alibaba continuing to rally. They've got news carrying through from yesterday with Apple, working with them to roll out AI features in China. That's according to sources, up 4.3%. But the whole of the China tech complex is roaring ahead. Super micro gains. So you've got revenue forecasting topping the street's expectations. And then on Lyft, look, down 12%, extending that post-earnings loss. The outlook on bookings, that was a clear miss. And they say that the cold weather has actually hurt demand. Danny.
Manus, I also want to give us a check on the yen this morning. It is weakening. It has slid for 3 days straight. It is now at a 1-week low. It's the uncertainty of tariffs. We know that Japan asked overnight for the Trump administration to exclude them from the new tariffs on steel and aluminum. But it wasn't that long ago we were talking about yen strength because of the Bank of Japan hiking. It's remarkable just how easy that's upended from the narratives coming out of America.
Yeah, I mean, that's the longest losing streak. What is it in a month? It's still the best performing currency. So it still has those haven characteristics. And I think it's important to sort of quantify the amount of steel and aluminium that goes from Japan. But good for them. They're asking for their exemption. It was 1.1 million tons just a couple of years ago. So about $2 billion. It's still the yen has all the hallmarks still of that haven status.
It's yet to be seen whether asking for an exemption works.
We were reporting qualification.
Correct. We were reporting that Australia had given good signals that they would indeed get one from the Trump administration. Peter Navarro coming out to say absolutely not. They are flooding the market with metals, and we can't give them an exemption. All right, that is it for your Bloomberg Brief. Surveillance will take the reins from here.